by putting in a definition which is really so wide, almost everything has been sought to be covered, and in fact the adjustments that we are seeing in relation to share capital are also being justified relying upon one of the factors that they are using is to rely upon this particular explanation. Now we move on to some of the case laws in relation to loans. We start with Perot systems. This is one of the earliest case laws that we had on this subject. So where the issue really was whether an interest-free loan can be given, and in this case the assessee had given an interest-free loan to its overseas subsidiary and said that this is really in the nature of quasi-equity, and they had also referred to the recipient country's laws where this has got characterized as a equity. And really the justification was that there is commercial expediency, I'm doing it as a shareholder, my subsidiary would not have been in a position to borrow. But these arguments were not accepted, and it was held that you need to charge on an arm's length basis, and so basically there has to be an interest-free loan could not be allowed. Similar was the case in VDF Limited. This is a Mumbai tribunal decision. Similar case where the taxpayer had advanced a loan to its overseas aid, and in this case the taxpayer did not have a borrowing. It was the loan was made out of free funds. The TPO sought to apply 14% based on an overdraft which the assessee had. Again, the tribunal ruled that first of all it cannot be interest-free. Whether you have a cost of funds or not is not relevant. You need to look at some arm's length rate of interest. But they disagreed. They did not accept the TPO's 14%. In this case, the assessee itself had another overseas borrowing from ICICI, which they looked at that rate. So in this case, Dr. Reddy's laboratories, here again, the assessee had actually charged interest at LIBOR. There were certain cases where it had charged different rates to different subsidiaries. TPO made an adjustment using 14%. Again, it was an ad hoc rate taken based on some Indian bonds. What the tribunal ruled that it was appropriate to look at the rate at which the assessee was able to deploy funds in bank deposits in India. So again, so this is a different kind of a benchmark used, a sort of an opportunity cost that I could have, if I had not lent it to my overseas aid, I could have parked the money in a bank deposit. So that's another way to benchmark. The next case law, Shiva Industries. This is perhaps a case law which has, I would say, correctly laid down the law on this subject, and it has been followed in a number of cases. So in this case, the taxpayer had given a loan to its associated enterprise in Mauritius using LIBOR rate. The tax office sought to use PLR-based rate, and ultimately the tribunal ruled in favor of the taxpayer, saying that you need to look at what is the currency of the loan, and if the currency of the loan, if it's an overseas market, overseas currency, the appropriate rate to be used is a LIBOR, and you should not be using or looking at a domestic PLR. And this, as I mentioned, this judgment has been followed in a number of other tribunal judgments, and I would say this really lays down the correct law as far as this subject is concerned. Some of the documentation that really needs to be maintained, the agreement and any correspondence evidencing the negotiation on the rates and other terms, any benchmarking analysis that is being carried out to determine the rate of interest. Typically, quotations are taken from banks. Again, today, if you look at Rule 10AB, it would in a way it's permissible to look at a quotation, because you can look at a price which is entered into or to be entered into. So a quotation to that extent could be used. So if a quotation is taken from a bank contemporaneously and kept on file, this would be a reasonably good defense. Also, what is the source of funds? If you are able to establish clearly what is the source of funds, that could be a factor. What is the end use of the funds by the borrower entity? So a lot of these factors have a role to play, and again we will see it in some of the later case laws, have a role to play in the ultimate interest rate benchmarking. So adequate documentation around these things is important. Again, these are the safe harbor rates. A loan up to 50 crores to a wholly owned subsidiary can be made at SBI base rate plus 150 basis points. This is SBI base rate as of 30th June of the relevant previous year. And likewise, if it's a loan above 50 crores, then it has to be SBI base rate plus 300 basis points. This is a safe harbor. This is something which is elective. At the time of filing the return, you need to make an election that I am availing this safe harbor, and thereafter there will be no scrutiny or no challenge from the tax authorities. Now, moving on, from loans we move on to accounts receivable. Accounts receivable has again been an area where there is a lot of litigation, a lot of controversy, and especially considering the 92B amendment of capital financing which has introduced receivables. This is an area which is now becoming really a cause for concern. The main issue really is that what is an accounts receivable? Really, an accounts receivable is it's a result of a transaction. So you supply goods, provide services, then there's a receivable. Accounts receivable is a consequence of the main transaction. So should it really be equated to a loan transaction? And whether interest has to be charged in every case where there is an accounts receivable or not? These are some of the key issues that we will deal with. These are some of the earlier case laws: Indo-American Jewelry, Nimbus Communication, Boston Scientific. These are old cases where they basically all said that a accounts receivable, which is a debit balance arising as a result of an international transaction, it's not a separate transaction in itself, but it's a consequence of the main international transaction. So there ought not to be any separate benchmarking, there ought not to be any interest. As far as any interest is concerned, it should only apply on commercial lending, not on these kind of transactions. These are the principles coming out of these decisions. But now this is negated because Finance Act 2012 has made this amendment, and very specifically the word receivable is introduced. Now the question that arises is whether a separate benchmarking exercise is still required. So again, I'm just sharing some thoughts here with you. That can I still argue that commercial expediency has a role over here? That there are industry specific factors. So take an industry like software, where it is very normal for customers to demand a longer credit period. There is no software company, at least to my knowledge, which charges on delayed payments from its customers. So is there an industry factor here saying that for software or for back office kind of services, there is really no justification for me because all my competitors are giving long periods of credit? That is the industry reality. Also, there are enough and more instances where today customers are demanding what you would call vendor financing. So where they would force the vendor to give a longer period of credit. So these kind of instances are available to establish commercial expediency. Now, coming to the regulatory framework, if I look at Rule 10A, transaction includes a number of closely linked transactions. So here, can you make an argument that the receivable is really intrinsically linked to the main transaction, which is the provision of services or the supply of goods. The rules would, to my mind, support that. Now, if you're using a margin-based method, and let's take TNMM as an example, I'll read out the relevant rules. The net profit margin arising in comparable uncontrolled transactions is adjusted to take into account the differences in and blah blah. Now, question is that when a transaction includes a number of closely linked transactions, can you say that the receivable can also be benchmarked under a margin-based method? And if I am using TNMM and if I am getting a margin which is higher than some comparable, then is it really necessary for me to look at that receivable separately? And I think this is not being tested, but there could be an argument to that effect. And furthermore, if you are able to make a working capital adjustment, the working capital adjustment, what is it ultimately? You are just adjusting for whatever period of credit you have given extra or away from both your debtors and creditors and equating that with the comparables. So once that adjustment is made, then is there really any further need to make an adjustment on account of these overdue receivables? Again, as I said, this is not, there is no case law around this. This is just a thought which I thought I will share with you. Now, this is a Bombay High Court decision on this subject. Here the facts were that the assessee was not charging interest on overdue receivables, both to A's or non-A's. So the Bombay High Court, again this has gone to the tribunal. Bombay High Court held that there is a complete uniformity in the actions of the taxpayer. You're very clearly able to establish, I don't charge to my associated enterprises, I don't charge to my third parties. When they said if that is the fact pattern, then you cannot force or you cannot make this adjustment. So, and this decision, this Bombay High Court decision is after the Finance Act 2012 amendment. So although they have not specifically dealt with how the amended provision would apply, that is not discussed in the decision, but the decision is clearly delivered after the amended provisions were in place. This is a case where the Bombay High Court decision was actually slightly distinguished, the Mumbai Tribunal. Now in this case, the maximum delay to non-A's was only about 200 days. But as far as associated enterprises was concerned, the delay was 1200 days. So what the tribunal held is that the A transaction and non-A transaction is not comparable. So this means that today, let's say if I have 99% of my transactions with my related party, and then I catch one third party somewhere and just try and establish a long period of credit with that third party, that may not be acceptable. So I have to clearly show that it's part of my commercial practice not to charge to a third party, backed up by a large volume of transactions. And the delays should be similar. So in this case, they distinguished it on facts, and therefore they upheld the adjustment, but they said that you give a period of 200 days, give a credit period of 200 days, anything beyond that make the adjustment. Because 200 days is what I was giving to third party, beyond that make an adjustment. Tech Mahindra's case, this brings out the principle that the interest rate prevailing in the debtor country is relevant. So the facts of this case was that the assessee had charged interest at different rates to different subsidiaries around the world. The DPO picked up one of the rates which he felt was most favorable to the revenue and applied that in all cases. Now the tribunal held that ideally, so since no interest is charged to third parties, ideally nothing is chargeable, but CIT appeal had upheld he had reduced the adjustment to 2%, which was the LIBOR rate applicable in the US. So that was ultimately upheld because the assessee was not in appeal. But they did observe that if there is since nothing is being charged to third parties, ideally there should have been no interest included here. Again, couple of favorable decisions on accounts receivable. Evonik Degusa, here the principle is that the taxpayer is a zero debt company. The taxpayer is not suffering any extra cost on account of the extra period of receivables that they are giving, and therefore there should not be any adjustment made. Similarly, in the case of Lintas, in the case of third parties, they were giving third party customers were being given a period of 97 days. Again, no interest was actually being charged, although the contract specified some rate of interest. And in the related parties also there were similar delays. And they observed, like in the decision, they have observed one particular party where the delays, the period of payment ranges from 4 days right up to 496 days. So it's a very normal commercial practice to get delayed payments, and therefore this adjustment was deleted. Now we move on to guarantees and letters of comfort. So again, this is just what is a guarantee and so on. I will not read through it. We will again deal with it when we are talking about case laws. So again, what is the reason why companies are today giving guarantees? There could be reasons where a company they want to raise funds overseas without having to block the funds of the Indian company. This would be the very normal reason why a guarantee is given. You also may need to have working capital requirements, fund your overseas subsidiaries, a very normal commercial requirement for giving a guarantee. Typically, a lot of these guarantee transactions, the Indian company would give a guarantee to a local branch of a foreign bank. In turn, the foreign bank will fund the subsidiary overseas. This is typically how a lot of the guarantee transactions would work. So factors to be considered before charging a guarantee. So whether a guarantee is implicit or explicit. So again, implicit and explicit means that merely because let's take a group like Tata's. Let's say Tata's is a subsidiary somewhere in the world. The mere fact that the company is associated with the Tata's will give it some degree of standing, because just to maintain or protect the reputation that the Tata Group enjoys, they will never allow any subsidiary to fail. So that is called an implicit guarantee. An explicit guarantee is where I actually give a formal letter to a banker saying that I undertake the obligation. If the company fails to meet its financial obligations, I will step in as a guarantor. That is the explicit guarantee. And we'll deal with the case law which looks at what is implicit guarantee and explicit guarantee. Again, why is the guarantee required? What is going to be the end use of the funds? So again, whether it's a SPV which is just making a further acquisition. So is it really whether it is really supporting the subsidiary's business, or is it something that I'm doing as a shareholder which I want in order to make an acquisition? Then other factors like debt equity ratio, amount of guarantee, foreign exchange, foreign currency risk, period and terms of guarantee. The principles involved in guarantee benchmarking are very similar to what we went through as far as loans are concerned. Now, the other issue that comes up is typically that is guarantee something that is a shareholder activity? Am I obliged to support all my subsidiaries, and therefore is it a service which is benefiting the subsidiary, or is it something that I am doing as a shareholder? This is that one typical issue that does come up. One way to look at it is that if you have a new subsidiary somewhere, on a standalone basis, the subsidiary probably is not going to have any creditworthiness. Now, as a shareholder, it would be your obligation to at least bring up the subsidiary to a level where it is creditworthy. So one way to look at it is that whatever guarantee is to be given, to bring it up to a creditworthy level, so let's say in terms of credit ratings, something that pulls up the credit rating to BBB minus to my mind, could be positioned as a shareholder activity, and something beyond that is something that is giving them additional benefit. Again, a lot of these things are not tested out, it's not coming out of any decision, these are just some basic principles that I am sharing with you. How to determine a guarantee fee? As I said, if it's akin to a purely a shareholder activity, no fee should be attributed. So I open a new subsidiary, standalone rating would be D. I give a guarantee to bring it up to BBB minus shareholder activity. If akin to services, so if I am giving it a tangible benefit, that BBB minus is going to go up to AA, then that is a tangible benefit I am giving, and the benefit the subsidiary will enjoy is by way of a reduced rate of interest. That is the benefit that I am giving. Now benchmarking can be on the basis of there is a yield approach. Yield approach is essentially what is the saving in interest that the subsidiary is able to enjoy. Or you could also have situations where you get third-party quotations. Now the department's approach in benchmarking of guarantee fee is really to insist on an arm's length compensation regardless of the purpose for which the guarantee is given. So we have a case where a guarantee was given to, this is a reported decision, where an Indian company which was making a major acquisition had set up a SPV, I think in the Netherlands. An Indian company had given a guarantee to enable the SPV to raise funds in Netherlands to consummate their acquisition. The TTO simply looked at the naked credit rating of that SPV, the credit rating of the holding company in India, and the difference was an adjustment, and that adjustment came to something like 10%, which incidentally was higher than the amount of interest that the SPV was paying. That's a separate issue. Again, the Indian tax authorities will look at domestic benchmarks. So they will look at whatever the difference in credit rating is, they will translate into what that would be in terms of domestic interest rates and accordingly make an adjustment. Also we see the rates which are provided by different banks on their websites. The banks will say that we will give a guarantee at 3% or 4%. These kind of rates are being picked up and used in assessments. So again, as we mentioned, as we discussed earlier, the India chapter in the UN manual, there is an India-specific chapter to the UN practice manual where India has stated that insofar as guarantee transactions are concerned, they would use the comparable uncontrolled price method, and they would look at the difference between the credit rating of the provider of the guarantee and the recipient of the guarantee, and translate that into Indian rates and calculate the guarantee fee. This is the case law, GE Capital. This is a case law which is one of the most important case laws. It's not an Indian case law, but it's very important in laying down some of the principles that are involved in guarantee benchmarking. So the facts are like this. GE Canada, it's a financial services company which is involved in financing and leasing of various products. They finance their operations by borrowing from the local capital markets. This was guaranteed by the parent company, which is GE US. And GE US started charging a guarantee fee of 1%, which was claimed by GE Canada as an expense. The Canadian Revenue Authority, CRA, they disallowed this deduction, and then this matter went into appeals. What the courts decided is that you need to look at what is the implicit support that is available as far as, so what is the benefit that is being derived as a result of the guarantee? One, the fact that GE Canada is part of the GE group gives it a certain support, gives it a certain credit rating. and then a formal letter from GE US, which is an explicit guarantee, further enhances the credit rating. So in fact, if you go to the next slide, you will see here GE Canada's credit rating without explicit support, it was significantly below the rating of GE US. GE US is a AAA rated company, and by giving explicit support to GE Canada, it is substantially able to enhance the credit rating of GE Canada. Now, the interest saving that GE Canada gets as a result of this is 1.83%. So what the court held is that since the saving is 1.83%, it is reasonable for them to pay a guarantee fee of 1%. So the total interest saving is the maximum amount that of the benefit, and which would have to be shared between the two parties. Coming to some of the Indian decisions, this is one of the first decisions on guarantees, force of Hyderabad Tribunal, which actually held that a corporate guarantee that is given does not fall within the scope of international transaction. Again, this decision predates Finance Act 2012. So now this decision will no longer have any application, because now post-amendment guarantee is specifically included in capital financing. Now this is a more very recent decision which has come out in the case of Bharti Airtel. In this case, the taxpayer has issued a corporate guarantee to an Indian bank to facilitate a loan to the AE. They did not charge any guarantee commission to the associated enterprise, but the taxpayer made a suo motu adjustment of 0.65% based on some market quotes. The transfer pricing officer, based on some external curves, determined a guarantee fee of 4.68%. Now the facts were like this. In this case, although this guarantee was given, the subsidiary had not actually drawn down. So there was actually no loan which was taken. So there was a guarantee in place, but the subsidiary had not actually taken any benefit. So in that particular year, there was no cost associated with this. The arguments that were being taken by the assessee is that this is really part of a shareholder activity and there ought not to be any guarantee fee charged. Now the tribunal has made a very interesting ruling. Now they say that in order to satisfy the explanation to 92B, so they said ultimately the explanation that was introduced, that is subservient to 92B, and in order to meet that requirement, you need to be able to show that there is an impact on the profit, income, losses or assets of the taxpayer. Now in this case, the revenue has not been able to show that there is any impact on the profit, income, losses or assets either currently or in any future year. All that has happened is that it is contingent. There could be an impact, but it is a contingent impact. And so they have made a distinction between an impact that is as of now or in a future year and an impact that is contingent. So based on this distinction, the tribunal has held that this is not an international transaction. Now, what is not very clear is to what extent has the tribunal been influenced by the fact that the loan was ultimately not taken in this particular year. Would it have changed if they had actually taken the loan in the year? Would it have changed the tribunal's view? Second aspect that has not been dealt with is they have not gone into the fact that this could be a service. So whether or not it meets the definition of capital financing, and for capital financing, yes, profits, income, losses, assets for the year